Hey everyone, this is a trader investor coming to you for another SPY demand zone, supply zone conversation. SPY trading is what I've been doing the last couple of weeks because it's really important once you understand the concept on just one ticker and you apply it across any asset class, cryptocurrency, futures, equity, ETFs, anything that is tradable, you can apply it to that. So last week I did mention how an order block became a demand zone. The order block was met, the hourly order block was met, and as soon as price mitigated this down move to take the price up, that's what an order block is. Then as soon as that mitigation happened, it became a demand zone, and price in a couple of hours went back and tested it a couple of times and picked up all remaining orders and took off from there. It took off from there. That was what I mentioned last week. So we don't need this order block, because for me, once an order block is mitigated, once a supply zone, a demand zone is taken care of, meaning that the price has gone back there and picked up the rest of the orders, I am not interested to look at it again, because it becomes weaker and weaker and I just look for newer opportunities. So last week when I mentioned this demand zone, a couple of times price went there, I said, hey, look at this supply zone and look at this supply zone up here. We want to make sure that when we are having anything like that, we want to make sure that price penetrates, maybe tests it and continues, or completely penetrates, or it fails to penetrate and rejects it a couple of times. And it could reject it in a different manner. It could reject it with an upside down pin bar, railroad tracks, any form of a candlestick pattern. That's where it could get rejected. You just want to make sure that you're validating that rejection, and the confirmation is when price tests it, fails it, and it retests it again, but this time is unable to go through and price goes down. That's one way to validate. So if you follow what I've been doing lately, and I say always trend is the key part, so trade with the trend if you follow that. And for me, the trend, long-term trend, is upward. I look at the daily, and that daily is in an upward trend. So if I look left to right, price is going up. That's what I mean by the trend. So long-term trend is in the trending upward momentum. So when I'm looking at that, I am not going to say, hey, I'm at this supply zone, let me enter short, right? On Friday, we failed to go to the supply zone. Not only did we fail to go there, but when the price pulled back from there, it did not even go below VWAP, right? It was a very, very shallow pullback. And for me, I always tell you, if you don't have a dollar move to where you want to take that position, if you don't have a dollar move, don't take it. And so there was no indication for us to enter anything here, even though price went down $1.20 or so. But there was no candlestick formation, there was no chart formation, there was no significant rejection at the supply zone for us to attempt this $1.20 move. So that's why when you trade with the trend, you'll have a much better success, because the goal is not to capture, let me show you. The goal is not to capture this move, right? That's not the goal. The goal is to capture this move. This is significantly much better move, right? And the goal is to capture this move and not guess at this move. Because if every time you try to guess at this move, price will just hurt you. It will hurt you really, really badly, because if you had said, hey, this is a rejection and I'm expecting price to do this, and you have a position open today, that position got wiped out, got terribly wiped out. That's why, you know, we don't gamble. We just stay with the trend and then look at area of value. And so our area of value, the supply zone, Friday it failed to clear the supply zone. It failed to really penetrate it. Today it passed this supply zone. So for me, this says there are no significant short orders, right? There's no lot of selling pressure to take the price down here. There were some here, price came down, went back to that zone, picked up additional orders and really drove price down, but the next time it came near that area, it wasn't there. Even if we look at the extended hours, like overnight, Sunday, because the future market was open Sunday, and also the late trading hours Sunday showed us, and Monday morning showed us that this move was inside this supply zone. But inside the supply zone, again, we didn't see a failure to continue price down. We actually saw failure to attempt to take it down, and price went back up. So when you're breaking these highs, you know this is an area that is really strong. So I don't look at extended hours. I just point it out for educational purposes only. I just focus on the main hour. So when price failed to do anything with this supply zone, and I'm also happy not to trade against the trend, I take that supply zone out. And now we have a second supply zone that price came to. It went there. It seems like it stalled for a short bit. Again, if you had attempted to do this, you are wiped out, because price momentarily stayed in this zone and took off. It did not go below it. It did not go below it, and is still playing around there. So it's not a good idea to try to pick tops and bottoms. For me, I just look at these zones, area of value. When I reach an area of value that coincides with the trend, that coincides with other analysis that I do, that coincides with support resistance, with Fibonacci and all of that, this is a good place to enter. So again, this supply zone is now out of the way. It is no longer a supply zone. What do I mean by that? Why is it out of the way? A zone, demand zone and supply zone, just to recap, a demand zone means large institutions placed an order, price moved quickly from that area, so they have some orders open. And then when price comes back, those open orders will take price and reverse it from the pullback. Same thing in supply zone. Institutions place a big sell order, price moves down quickly, so those orders, some of those orders are left open. When price comes back there, as long as those orders are open and they're large enough, price will shoot back down. If price fails to shoot back the opposite way, right? Supply zone down, demand zone up. If price fails to do that, then we know it's broken, right? It is not holding. It means there's no significant order size waiting at that zone to reverse course. So in a pullback, if we come to a demand zone and the demand zone does not hold, that means there is not significant size orders to take the price back up. And by orders, I mean buy orders. If there's more sell orders, it will keep pushing it down. So if there's no significant buy order, it will not reverse. In a rally or in an uptrend, when we meet a supply zone, if there's not large enough sell orders sitting in that zone, the sell orders that were left from previous period, that could be last week, yesterday, last month, depending on how you draw your supply zone. If there's not enough sell orders, price will continue to drive up. And why would there be not enough orders? It's not because the first attempt they got all their orders filled. It's because they're also looking at the charts. They're also looking at fundamentals. By they, I mean the institutions, the smart money, that people that move large amounts of dollars, millions and billions of dollars. They're looking at different things and say, you know, in this supply zone, they were ready to take it short, and throughout last week they might have decided, you know what, all the orders that were filled, that's enough for us, we want to take them off, we don't want to put any more orders in, and they cancel all their remaining orders. Or they would say they would have enough orders to try to take price down. As you can see, when price stalls and does a little bit of a try to push back down, but other institutions, other smart money has larger orders on the opposite direction, therefore they will get filled but they will lose their money. So that's why it's important to look at these supply zones and demand zones. And once price goes through, for me this is no longer a valid zone that I'm going to consider. I don't care about this zone anymore. It can come back and be happy with it, but for me that's not an area that I am interested in. If price were to drop, this would be a supply zone that I would draw, but price has not shown me where it wants to go yet. So for me, an order block that I see is, we have this rally, pull back, rally, and then it based here, it stayed here for a while. So this could be a demand zone. This could be a demand zone. And so if price then comes here and retests it, this is an area for us to get a buying opportunity to take price back up to the upside, as long as we're getting confirmation and price is not blowing through it. We keep making higher highs, we're cautious as we see extension, and we look at our oscillators to make sure there's no divergence, and as long as we don't have any significant divergence to look at, because for example here price is making higher high, my oscillator is making higher high, so no divergence, so I am good to go on this one. So I'm nothing to be concerned with, so I'm happy to enter a position if price gives me an opportunity to come down here. I will enter a position up here as long as I get that confirmation. So overall, we took care of a couple of demand zones, and now we are patiently waiting for our next position. Right? I'm giving you some of these ideas so that day trading doesn't become something extremely difficult. Right? You trade it when price comes to a demand zone versus looking at options to look at, am I going to look at moving average cross or some Fibonacci level just randomly. Outside of that, you can just look at these demand zones and supply zones to enter good positions, and those positions could turn into single day position, or they could turn into a swing position. For example, last week on Thursday, when we tested this demand zone twice, this was an entry, and this zone, you would take it Thursday, you can close it Thursday at a decent profit, or you can hold it knowing that we had another supply zone here, and by the end of Friday, because I don't hold overnight for the weekends, I close my position up here. So it gives you a couple of ideas for swing positions. And if you just look at this chart just very quickly, you can see demand zone here. When price comes here, we are taking it up, and then when you see here supply zone, right, when price comes down, price come back up here, you could make it a target 1 and hold, and then target 2 never hits, so you at least you have captured a lot of your gains and you exit the rest on the following day. So every time you see a possible area of entry, and when price gives you that, like in this instance, this demand zone, price just kept blowing through it, so you don't enter a position here. This is all putting everything together and then trading accordingly. That way you can trade out of the 1 hourly chart, or you can look at the 1 hour chart for your precision entry and then go down to the 15 minutes to have even more bullseye entry, like very, very targeted, pinpointed entry for you. So that either way, it just depends on how much you want to monitor the trade. Both ways are, it's an hourly chart or 15-minute chart. For the swing position, both are valid entries. Alright everyone, hopefully this has been helpful to you, and I will see you in the next video. Take care for now.